Good evening, everyone. Today we are group A13, which will be taken through mergers and acquisitions topic. And Roshan, please continue with the slide. Right. We have taken two major companies which acquisition happened. The Fox company was acquired by Disney. So, firstly, 20th Century Fox was an American multinational mass media corporation that was based in New York. In 2013, they started operations, and then the Fox created in as a merger between 20th Century Pictures and Fox Films. In the year of 2019, the acquisition by very well known the Walt Disney Company as Disney had took over with value of $71 billion, and this is the fifth largest company which holds a market value of 239.8 billion according to New York Stock Exchange values. And the key operations of Disney are theme parks, resorts, cruise line, broadcast television networks, and also produce live entertainment events, and also streaming variety of films and TV entertainment content through new digital platforms. And further, my colleague Roshan will take you through with the acquisitions details.
Let me explain why these companies decided to go for Axiom. The main reason was for Disney to improve its business. This deal allowed Disney to provide more appeal, high quality entertainment options to meet rising consumer demands, expand its international footprint, and make more direct to consumer offerings. By 2016-17, there were many threats to Disney company because of the rise of online streaming platforms like Netflix, Amazon.com, YouTube, as well as uh, other newcomer like Hulu. So as a result, Disney came up with a way to compete with them. So they started an action project. It was a surprise actually when Disney announced that it was going to buy Fox Films for $52.4 billion. So actually, this deal includes 20th uh, Century Fox Films and TV departments, cable networks, and international television businesses. It also includes 30% of Hulu's stock. A big part of why Fox decided to sell this business actually came from a plan it made in 2014 to buy uh, Warner Films for more than $80 billion. However, after the action plan was announced, the stock price of Fox started to fall. This made actually Fox very underfunded. So in the end, Fox had to finally cancel the plan. So for causing a massive waste of its resources. So after this tricky issue, Fox could not maintain its market positions. In 2017, Disney came to Fox with a plan to buy them. So Disney, on the other hand, wanted to change their business model when there was a lot of competition from services like Netflix and Amazon Prime, as mentioned before. So like this, focusing on all the facts, growth theory is applied here from the theoretical perspective of this acquisition. Over to you, Saleh.
Thank you, Rashan. So, with the analysis of 6 feet model. So, if you take the operational fit, both Disney and 21st Century Fox are in the same industry, which is known as entertainment and media. So that operational facilities and the capex requirements are much aligned with the acquisition plan. So if you take this particular acquisition, it is a sort of a horizontal acquisition where the competitors are getting together. So the operational fit is justifiable. Then we move into the strategic fit. So considering the fact that Disney market competition, Disney had the requirement for shifting towards digital platform where the entertainment industry is heading towards. Basically, if we take, it is all about the digital streaming where the market is heading towards. So the entertainment industry is moving toward that particular digital streaming platforms. So Netflix is enjoying the lion's share at the moment in this industry. So Disney really wanted to capture that market and for the sake of growth and the strategic requirement to be fulfilled. So they were searching for this particular opportunity so that they connected this 21st Century Fox to their strategies, and so that the strategic fit is very much justifiable. So Roshan, shall we move? Okay, slide is not moving. Still, I will take you through the next analysis was made on the marketing fit. So, if you take both Disney and 21st Century Fox are in the same market, catering to the same clientele. The biggest advantage that Disney had with this acquisition is that 21st Century Fox had their own studios, movies, and libraries, which could facilitate the and enhance the streaming content. So Disney was really actually short of the content factors to their streaming, uh, so that they had already given the license to Netflix to streaming their own content because of the lack of content that they had. So with this acquisition, actually the marketing strategies got changed. So they could actually start streaming their own libraries with the 21st century's libraries and movies. So that the marketing fit actually took place with this acquisition. Okay, Roshan, next slide. Okay, if you take the financial fit, 21st Fox had been the fourth largest in the industry by acquiring 21st Century Fox by Disney. It made Disney to ensure that they are ranking at the top by increasing the market share and thus assure the financial strength. If you take now in the market content, actually the Comcast was the market leader at the time of acquisition, but with this acquisition, the market share actually took over by Disney, since the 21st Century Fox had a considerable share since they were in the fourth in the competition list. So they came into the top. So the financial fit actually justifiable with this particular acquisition. Prashant? If you take the investment fit, actually the deal closed at USD 71.3 billion. The investment made considering the digital streaming service enhancement, that was the biggest factor that need to consider during their acquisition, because so by acquiring the 21st Century Fox, they could actually utilize the movies and the TV libraries of 21st Century Fox could contribute to Disney's streaming content library expansion, because Disney had already started their streaming content and their facilities with an acquisition of a small streaming content library. So they plugged it to their own content and started sharing through their streaming. So the investment fit was there. And if you take the financially, again, the approximately 71 billion, including this 35.7 billion in cash and nearly 35 billion in Disney common stocks, were paid to their former holders of 21st Century Fox common stock in the results of the merger. So this particular acquisition didn't come into play with some borrowings. So their own fundings and their own shares actually were used to acquire this particular company, so that the investment fit is very much justified. With this, I hand over to Kanishka to take you through the valuations.
Okay, thank you, Saleh. So I will go through with the valuation process happened in the acquisition between Fox and Disney. So the main valuation method they have used is discount and cash flow method, and the transaction valued at US dollar 52.4 billion. And next slide, Roshan. So we have calculated the asset-based valuation to check whether it is why they have moved to the discounted cash flow valuation process. So as you can see, according to their annual report, we have calculated the asset-based valuation as $9,594 million. So it is actually a 5.46 times. The actual amount is actually 5.46 times more than the balance sheet value. So the basic reason is for this is most of the entertainment companies doesn't have the intangible assets, because so the investors they don't look for much about the assets like tangible assets, and the main assets they have is like movies and other movies and movies like that. So because of that they have not gone for a asset based valuation process. So next slide, Roshan. So when it comes to PE valuation, actually we have did the calculation. So for the PE ratio, we have considered the average industry PE using the most highest competitors like Comcast, Netflix, Dish, and then we have got the PE ratio as average PE ratio as 14.46. After that, we have calculated the PE valuation for the Fox, and we got the value as 36 billion US dollars. So it is actually the lesser value than the deal value. And we have calculated again the PE ratio using PE ratio Fox solely. So it the value came around like 40 billion US dollars. So the next slide, please, Roshan. So the actual valuation happened according to the discounted cash flow valuation. So I will pass it to Shashini to explain about this.
Thank you, Kanishka. Given that the purchasing of Fox company is viewed as a Disney's long-term investment, for the future estimation of Fox future cash flows will be discounted at Disney's WACC plus the opportunity cost that Disney get out of this acquisition. So the opportunity cost will give us an idea about the potential return of Disney's investment. In order to estimate the opportunity cost, they have implemented the CAPM formula of the Fox beta, which is 1.23. Hence, the overall discounted rate has been ended up as 14.24%. As you can see in the graph, the overall analysis indicated a value of $51,719 million under this discounted cash flow method. However, the purchase consideration has been ended up at 52 billion, which is quite higher than the value we have got in this discounted cash flow valuation. So over to you, Tinina.
Thank you, Kanishka. Our next to discuss about the post acquisition review. Actually, during this 2019, we know in 2020 there was a pandemic situation in the world. Even though that pandemic situation was happened, Disney had to earn a considerable amount of growth. Then my first graph shows that the revenue growth, when it compared with 2019 to 2020, it has a increasement. So and the second graph is about net income growth. That also you can see in 2019 there was a 6% of net income growth, but in 2020 it was increased up to 9%. The last improvement is per share value. So it mentions that in 2018 the per share value was around 51, and when it comes to 2020 it was 140. So by considering these all factors, we can evaluate the decision of the Disney is successful. So next to discuss about the final evaluation. So the benefits of the acquisition. First, we can mention it enhanced the market competitiveness. So we know by this acquisition was successful and it was a great competitive for other competitors. And the second one is enhanced bargaining power. So and the third one is enhanced influence in the online media streaming field. The acquisition expand these three areas, and Disney successfully achieved their expected target. So finally, I would like to inform the transaction is successful, and this is about our presentation. So we are in the end of our presentation. So thanks for you the listening, and have a good day. Thank you.